Okay, so it's a great pleasure to be here. What I'm trying to deliver in a few minutes are some thoughts about the implications of financial complexity for, in particular, policy and in financial regulation. So this is joint work with a number of people, and in particular, I want to acknowledge two European projects which have been funded by the European program FAT, Future Emerging Technologies, which I coordinate, and it is Dolphins and Symbol. So let me start from a diagnosis. And this has been raised up by other people, number of people before in the previous session. Well, essentially, according to the recent estimates of the European Central Bank and the IMF, financial crises on average cost 5% of GDP in terms of net fiscal cost, and this is the net of what is actually recovered from after the financial assistance to financial institutions. So this is these are big numbers. These are big social costs. Now, there is an intuition about the fact that the increasing complexity of financial networks, and there are two ways in which this complexity materializes, both the structure of contracts and actors, and the nature of the contracts themselves. There's an intuition that this may actually increase the potential for information asymmetry and hence market power and hence market manipulation. And but this intuition has remained so far mostly an intuition, although there is a number of works, and I would like to mention a recent book by Akerlof and Schiller about fishing for fools, and mind the spelling, which is intentional. It's actually quoted. Now, this is actually a previous version of the slides that. Okay, I can manage of the slides. So let me start by with a simple slide where I illustrate what do we mean by financial networks. Basically, what we have in mind is a set of financial institutions, say bank. What you see in this slide is a simplified a representation of their balance sheet, so assets and liabilities. There are three banks in this particular case. The blue links refer to the fact that they have invested in some portfolio of assets which might be overlapping, and that was one of the topics also in previous talks. In addition, they lend to each other on the interbank market. In this particular case, they form a cycle. And cycles are empirically relevant, as I will show in a moment. Not only that, but also we need to bear in mind, and I have a slide at the end, that the relative share of the interbank assets of an average medium-sized to large bank in Europe is pretty large. We're talking about 3 or 4 times the amount of the equity, and it's actually more than what banks are lending to the real economy. So the size of the interbank is larger than the size of the bank's asset in the real economy, is even larger than what they are lending to mortgages for to households. So it's a linkage that we cannot neglect. Now, price of complexity. Actually, what I really mean here is the social price of complexity. So by creating this potential for information asymmetry, there are essentially 3 sources of uncertainty that complexity creates. There are at least one, there are 3, but these are the 3 that we have been recently working on. So the first is that even excluding other sources of uncertainty, when you have a complex network of contracts, then small errors on the information of either the structure of how of who engages in contract with whom and or the nature of the individual contracts lead to potentially very big errors in the estimation that the regulator may make on the systemic default probability, which means that basically the regulator might be setting aside too much money or too less money, and in both cases it's a social cost. The second is that in a quite large range of the parameters, is when you have a large interbank market and you have cycles, and we have precise theorems about when this happens, what are the sufficient and necessary conditions for this, then you have the emergence of multiple equilibria in the determination of who defaults. And this again leads to uncertainty both on the side of the market participants and on the regulator. And the third point is the third source of uncertainty is that there are even conditions when under which certain types of contracts, for instance, derivative contracts, and in particular credit default swaps, which create essentially payoffs which are non-monotonic and non-linear in the state of default of the counterparties, then you even have conditions where you have inconsistencies of the payoffs or inconsistencies of the default state. An example is if A is simplified, okay, but you can show that this is when it is relevant in a particular in a concrete case. If A is long on B and but B is short on A, then if B goes well, then A goes well. But if A goes well, then B goes actually bad. So B is actually going bad if and only if it's going well. So you have an inconsistency, okay? And you can, the major difference with respect to traditional contract is that most traditional contracts are essentially long, and then when people goes bad, you might go bad as a result of the contagion. Once you have this new, I mean, it's not new, I mean, credit default swap has been around for 20 years, but when you have more complex contracts, then there are other dynamics that can go on, and very remarkably, very interestingly, nobody has been, to our knowledge, have been studying how these contracts interact in a network. And to show that this is relevant, let me go on some examples. This is a gallery of financial networks. It goes from interbank payments, target 2, then to equity holding, interbank loans, co-movements in the credit default swaps, and credit derivatives. And let me open one parenthesis, because I think there is a big elephant in the room that we should mention here. This slide shows 5 cases of very recent market manipulations which have been in the newspaper, Bloomberg News, Wall Street Journal. So that these cases have been discussed and denounced by finance journals and websites. And we're talking about the credit default swap manipulation case, the precious metal, the Forex, the LIBOR, that was already 2 years ago, and the commodity derivatives. Now, this slide shows who are the banks that have been involved in these cases, the equity holdings that they hold in each other. So far, equity holding has basically been the only data that was available, at least publicly, plus the common directors that are sitting in the boards of directors. Now, let's focus on the case of the credit default swap, which is actually 3 weeks old. And so these are the banks that were involved. Now, I cannot show the names, but those 12 guys, I can tell you, that are in the blue, in the set of blue nodes that you see in this picture. What is this picture representing? Now, this is very confidential data underlying, but this data can be shown as it is. This is joint work with the European Systemic Risk Board. Very, very recent, is about to come as a working paper. And it's a novel methodology to analyze and display and measure quantitatively the flow of risk in a market. How is the risk flowing from those who are selling the risk, that means those who are buying protection, those who want to buy protection, and which are the guys you see on the left, they actually happen to always buy this protection from a group of dealers who are passing this protection many times over among each other, and eventually this protection is bought from ultimate risk seller or risk buyer, sorry, or protection seller, which are on the right. So now, very interestingly, we find this structure for every single reference entity. And now there are a number of theorems that can be, okay, this was in the other version, no problem. There are a number of things that can be said. Actually, you can show that this structure is basically dominating in terms of systemic risk any other structure that would be more, market structure that would be more fragmented. And in particular, that if any of the guys that are on the right, who are the ultimate protection seller, would be in distress, then potentially all the guys that are downstream are actually potentially in distress. Now, what is the policy implication of this? Well, essentially, we need to realize that we have, in addition to all the things that we said before about the information asymmetry, we have built markets which are inherently bearing systemic risk. Plus, in addition, we let market grow in a way such that there is a very interconnected core of dealers, which in terms of total asset represent, I mean, their total asset combined is larger than the one of the European Union or even the United States. So obviously, no one can deny that these guys have a very huge influence on the regulatory process itself, and that's something that I don't think it's discussed enough. So let's move forward. The message that I want to deliver is, in my view, and I think that this view is shared by a number of people working in, a number of colleagues working in the related projects, crises are not black swans. There are a number of ways in which you can measure and understand the imbalances that are building up. And I'm citing here one example. There is the notion of credit gap, or the notion of real property price gap. Essentially, you can, if you compare certain macroeconomic indicators with respect to their long-term average, you can detect the fact that you are getting very much away from the long-term average. So, for instance, everybody could see that the prices already in 2006 for real estate were very much departing from the long-term average. And now, and this comes back to the discussion on prediction that Ralph was mentioning today, we need to understand that in complex systems, and financial systems and economic systems are, I think we agree, complex systems, we may not expect to be able to predict the exact day in which things blow up. But what we can do is to measure what is the state of, measure the danger. Is to use a metaphor, you cannot, I mean, if you're driving a car down the hill in the mountains, you might not predict the exact curve at which the crash will happen. But is this really important? No. What we really want to measure is how used up are the brakes and what are the conditions of the cars. And then the probability of having a crash will be just proportional to how much in bad shape is the car. So I think there are three elements, and then I think that this is my main message for today. Fantastic. I think there are three drivers of systemic risk, which people have started being combining, in particular in this community, but more work is needed, and we are trying to contribute to this. One element is macroeconomic imbalances, which is essentially looking at macro indicators, which are summarized in an aggregate way. As I said, how much, if you want, energy potential there is in the system to then be released, to use a metaphor from physics. The second element is interconnectedness. And interconnectedness has to do with the fact that what you see here represented is linkages between the banking sector and other subsectors, if you want, of the financial system in the euro area. And then for each of them, you have data on balance sheet, and then you can expand and see what are the relationship and the mutual exposures. And we need to understand that, that there's been now substantial and established work to show that these linkages actually amplify initial shocks by a magnitude that can be easily be of a factor 1 or 2. That means if there is a direct shock coming from the let's call it exogenous, then because of the fact that you see that here in this slide in the euro area, basically the interbank loans are larger than loans to the real economy and to loans to households, which basically mean, plus not to mention all the derivatives, these are all basically assets whose value depends indirectly on values. For instance, if they're built on house prices, they will amplify the effect of the shocks. And the third element is definitely leverage, and that was one of the topics of the previous session, which I found really interesting. So you need to understand that leverage is basically making each unit in our complex system potentially unstable. And that is connected to the macroeconomic imbalances because, in fact, if banks are investing in assets whose value from a macroeconomic perspective is completely unsustainable because they're related to a bubble, that makes intrinsically unstable the units. And now when you add in interconnectedness, you are making all these units which, being unstable, if they burst, they could burst independently. Now you can't connect them, and then by construction, you're just building systemic risk. So I think that this is the way forward. We need to build, this is just a first example, but not everything, not all the three elements are in here, only leverage and interconnectedness. There are no, the macro imbalances are not included. I think this is the way forward. We need to understand that risk can be monitored, although we cannot make detailed prediction on when it will, the risk will materialize. But this is actually not so important in my view. And so we need to understand that it is possible to do things. And the final conclusion, because it was mentioned in a previous comment, whether being the system complex, maybe we cannot control it. I want to maybe raise also for comments to the other a bit provocative. That is true, but on the other hand, we are responsible much more than we think about the design of the system. So maybe if our model doesn't fit the reality, to some extent we can also change the reality because this is actually social norms. It's a social reality that is part of our construction. So we shouldn't just be passively looking at this complexity and then say, oh, I'm sorry, we cannot do anything. Thank you for your attention.
Okay. Thank you.